History made. DBS has just smashed through the $50 mark for the first time ever, fresh off their second quarter results on 7th August, and investors are going wild. But here's the real question. If DBS is already at an all-time high, is it still worth buying now? Or is this where smart Singaporeans step in with the right strategy and lock in passive income for life? Stay tuned till the end, because I'm going to break down DBS's latest numbers, explain what dividend investing really is, show you how to be cash flow rich, and reveal two powerful ways, dollar cost averaging and crash buying, to invest in DBS without losing sleep. If you love Singapore investing content, hit that like button so more Singaporeans can watch this, and subscribe to Wealth for You so you never miss a money-making breakdown. Disclaimer. This video is for educational purposes only and is not financial advice. Always do your own research or speak to a licensed financial advisor before investing. Chapter 1. What is dividend investing and being cash flow rich? Alright, let's keep this super simple. Dividend investing is when you own shares in solid companies that actually share their profits with you, in the form of cold, hard cash, usually every quarter. So instead of just praying for the stock price to go up one day, you're collecting regular payouts while still holding your shares. It's like planting a money tree that drops little ang boughs 4 times a year. Now, here's the magic. Being cash flow rich means your passive income, like dividends, is enough to cover your lifestyle. You're working because you want to, not because you die have to. And here's why that's better than just being net worth rich on paper. If all your wealth is tied up in property, cars, or other illiquid assets, it looks impressive, but it doesn't pay your copay bill. In tough times, you might even have to sell something at a bad price just to get cash. When you're cash flow rich, your investments keep putting money into your pocket, month after month, quarter after quarter, no matter what the market is doing. Imagine your copay money, your weekend dim sum bill, even your monthly utilities, all quietly paid for by your investments. That's not just investing. That's financial freedom on autopilot. Chapter 2. DBS Business, Q2 Performance and Valuation Snapshot. Now, DBS isn't just another bank. It's Singapore's largest financial powerhouse, with a footprint stretching across Hong Kong, China, Taiwan, India, and Indonesia. Its business is well diversified, making money from loans, wealth management, trading, and transaction services. And it's no stranger to global recognition, having been named world's best bank multiple times over the years. Fresh from its second quarter 2025 results on 7th August, DBS showed exactly why it's considered the heavyweight in the region. Net profit came in at 2.82 billion Singapore dollars, up 1% from last year, and comfortably beating analyst forecasts. The bank declared a total dividend of 75 cents per share for the quarter. That's 60 cents interim plus a 15 cents capital return, putting real money straight into shareholders' pockets. What's driving this performance? Strong wealth management fees and trading income, which helped offset a dip in net interest income as rates edged down. On top of that, DBS has been actively rewarding shareholders through its buyback program, having repurchased 370 million Singapore dollars worth of shares so far, about 12% of its planned $3 billion. The market clearly approved. On results day, DBS shares surged to an intraday record of $50 before closing at $49.75. For income investors, here's where it gets even more interesting. Based on the past 12 months' payouts, DBS's trailing dividend yield is about 5.2%, already attractive compared to most global peers. Looking ahead, with its steady payout track record, the forward yield is projected at 6.1 to 6.3%. Even better, the payout ratio sits in a healthy range of 42 to 56%, meaning DBS is generous with its profits while still keeping enough for growth and a financial buffer. Put simply, DBS isn't just giving you paper gains from a rising share price. It's delivering a steady stream of cash, quarter after quarter, backed by sustainable profits. For long-term income seekers, that mix of capital strength, consistent performance, and disciplined payouts makes DBS one of the rare quality yield engines in the market today. So, even at near all-time highs, DBS looks like a stock that's priced for its quality, not a frothy asset inflated by speculation. If your goal is to build cash flow that works for you, DBS is exactly the kind of dependable tool that can deliver it year after year. Chapter 3. Critical Outlook and Fed Rate Cut Impact. Looking ahead, DBS isn't taking its foot off the pedal. The bank has reaffirmed its 2025 targets, aiming for net interest income to come in slightly above 2024 levels, even though interest rates are drifting lower. How is that possible? Well, the strategy is clear. First, DBS is banking on volume growth, more deposits, more loans, and a bigger base of customers. Second, it's leaning on its resilient non-interest income engines, like wealth management, global transaction services, and treasury sales. These are areas that can keep the revenue flowing even when lending margins tighten. But let's be realistic. With the U.S. Federal Reserve widely expected to cut interest rates, net interest margins, or NIMs, could come under more pressure. When rates fall, banks typically earn less on their loans compared to what they pay on deposits. That's why DBS is doubling down on balance sheet management, fine-tuning its funding mix, hedging interest rate exposure, and growing its fee-based income, which isn't as rate-sensitive. For investors, the message is this. DBS is still a fortress, but don't expect the same turbocharged profit growth we saw during the high-interest rate years. The bank is shifting gears, from a sprint powered by fat margins to a steady marathon built on diversification, disciplined risk management, and long-term customer relationships. In other words, DBS remains a strong dividend-paying engine. But the speedometer for earnings growth might read a little lower in the next few years. And for income-focused investors, that's perfectly fine, because what matters most is that the engine keeps running, the cash keeps flowing, and your dividends keep landing in your account, quarter after quarter. Chapter 4. How to invest in DBS at all-time high. Okay, so DBS is sitting at record highs. Should you still buy? The short answer is yes, but with the right mindset and strategy. See, investing in a quality dividend stock like DBS isn't about finding the perfect entry point. It's about owning a reliable cash flow engine for the long haul. And to do that, you need two powerful approaches in your toolkit. First, dollar cost averaging, or DCA. Set aside a fixed amount to invest in DBS shares regularly, monthly, quarterly, whatever suits you. By buying at different price points over time, you smooth out your cost and take the pressure off trying to time the market. The beauty of DCA is that it works quietly in the background while you focus on life, and over the years, your share base and dividends grow steadily. Second, crash buying. This is the accelerator button for patient investors. Market crashes happen, not every month, but every few years. And when they do, even rock-solid companies like DBS get dragged down by panic selling. Take the 2020 COVID crash. DBS plunged to around $17 while its net asset value was about $18 to $19. Investors who stepped in then locked in a 12% yield on cost compared to today's 4 to 5%. That's not luck. That's preparation meeting opportunity. The key here is patience. You don't force a crash. You wait for it. Keep a watch list. Set aside some dry powder. And when fear is at its peak, you act calmly while others are selling in a rush. Long-term wealth isn't built by chasing quick wins. It's built by owning quality businesses that can stand the test of time, steadily adding to your position year after year, and having the patience and discipline to hold them through both sunny days and stormy markets. The real rewards of investing don't come overnight. They come from staying invested long enough to let compounding do its magic, riding out the short-term noise, and keeping your eyes on the bigger picture. That's how you turn steady dividends into a lasting income stream that can support you for decades. With DBS, you're not just aiming for a stock price jump. You're building a dividend stream that could pay you for decades. Final thoughts. From DBS investor to cash flow rich. DBS crossing $50 is proof of how strong our local champion really is. But remember, you don't have to chase it blindly. With dollar cost averaging, you can start small today and let time smooth out your entry price. With crash buying, you can pounce when the market is on sale and lock in yields that could pay you for decades. Over time, those dividends can grow from a small stream into a steady river of passive income, enough to fund your copay, your holidays, maybe even your retirement. That's what it means to be cash flow rich. It's not about how big your net worth looks on paper. It's about how much of it actually pays you back, quarter after quarter, without you having to lift a finger. So let's invest smart, stay patient, and let DBS keep sending us Kopi money for life. If you found this breakdown useful, smash that like button so more Singaporeans can watch this, subscribe to Wealth for You, and press the notification bell so you never miss another strategy to grow your passive income, the smart, simple Singaporean way.